Hey everybody, happy Thursday, March 30th. It's about 12 o'clock on the West Coast and time for another market update. It's also a Major League Baseball opening day, so happy Major League Baseball opening day to all who celebrate. Go Dodgers. My apologies to all my Giants friends in the Bay Area, but that's how it is. So busy week, not as volatile as the last few weeks has been, but that's because things were crazy last couple weeks. Bank stuff kind of settled down, but let's get right into it. The first two things we got this week were the Case-Shiller Home Price Index and the FHFA Home Price Index, which are appreciation surveys. And basically what came in is that the Case-Shiller was down month over month, 0.2%, non-seasonally adjusted down 0.5%, still up year over year, 3.8%, and down from the peak last June, 3%. The FHFA, which throws out jumbo and cash deals, so tends to be a little bit lower price homes, that was up month over month, 0.2%. Year over year, it was up 5.3% still, and from the June 2022 peak, it's only down 0.6%. So far from the crash. These numbers, the down is down much more on the West Coast, but we also had the most gains during the pandemic. So, again, not good to see things come down, but good to see that house prices are staying resilient. So the next thing we got was February pending sales. So February pending sales were expected to come down 3%. They were up 0.8%, which was a win. And this is in a month of February where rates went up 1%. So it's good to see again that the markets and buyers are staying resilient and staying in there. Next thing we got last week was purchase apps were at 2%, and year over year they're still down 35%. So not good for the mortgage industry, obviously. But these numbers should start to get better as we're replacing worse numbers from last year. And again, as rates come down, activity tends to come up and purchase apps go up. Next thing we got, initial job claims. They came in a little bit higher than expected, 198 compared to 196,000. Still under 200,000, still really tight labor market. But keep in mind, this is a lagging indicator. Companies tend to slow down hiring, then they freeze hiring, and then they fire people. So right now, we got to keep a close eye on this because we know the Fed's really looking at it and using it as evidence why they can keep hiking rates because the labor market is so tight. So where does that leave us? Last week, we were at 6.44% average 30-year conventional, according to a lender survey, and now we're at 6.59%. It actually dropped a little lower, 6.38 on Friday. And then basically what happened is anytime the banks, the bank volatility helped us when the banks supposedly get rescued, it hurt us a little bit. So I would advise ignore all that bank stuff unless it goes really bad, then you'll be here to stay. But mainly we got to keep an eye on the inflation data and the unemployment data. So coming up tomorrow, we got inflation data. It's the Fed's favorite, PCE. And, we're not 100% confident that this is going to go well for us. And I'll tell you why. We're not replacing really high numbers. So the way it works with these inflation data is you're replacing last year's month. So really what we're thinking is towards the end of March and into April is when we're going to start seeing these better numbers. Because we know, shelter inflation is inflated. That should start, playing in our favor. So really, this May 10th date when the inflation comes out, that one report should be in our favor. And then a couple weeks later, we got a Fed meeting. Maybe that goes in our favor as well. And that's where we were hoping, we're predicting maybe that's when you're going to see a good rally in rates. As they are now, we're coming down, but not very fast. So the next thing I want to talk about really is recession. So you're seeing this word a lot about, thrown out about right now. A lot of the major economists, a lot of people with fancy degrees believe we're either already in a recession or we're going into a recession in the next 12 months. And so what this is the New York Fed probability of recession in the U.S. in the next 12 months, predicted by Treasury spread. So basically it's at its highest point since 1982, I believe. So even all these other recessions throughout my lifetime, throughout the 80s and 90s and 2000s, this indicator's never got this high. So again, lots of fancy people, a lot of smart people think we're in a recession or going into a recession. So I want to take a look at, what does that mean? If we go into recession, as a refresher, what does that mean for housing and what does that mean for mortgage rates? So first of all, one of the reasons why we think we're going into recession, unemployment is so low. Right before every recession, unemployment goes low. That seems a little reversed, but basically right before at its lowest point, recessions tend to kick in right after that point. So we know unemployment rates are low right now. So another indicator of recession's on its way. So we also know what drum in your guys' head is that inflation drives mortgage rates. Inflation is the main enemy of why mortgage rates have gone up. This salmon color one is CPI inflation rate, and then this blue one is mortgage rates. So as we can see, when inflation started kicking up, rates went up. When inflation started coming down here lately, rates come down as well. Next thing, does inflation come down with a recession? Yes, history shows big time. So generally, the start of a recession when inflation's high, by the end of the recession, inflation's a lot lower. So the average change in from peak to trough, from the highest to the lowest, is negative 6.8%. And again, when inflation comes down, so do mortgage rates. So again, showing you right here, when a recession happens, generally mortgage rates go up and then come down. As we're coming out of the recession each time, rates are down. We see it peak at the beginning and then start coming down. So again, keep in mind that generally, mortgage rates come down during recessions because, as far as with inflation coming down and so forth. So what does that do for housing? So housing, besides 2000, the housing crash that we think of, 2005 to 2009 or so, housing stays strong through the recession. Every other recession, housing either stays flat or has slight upticks or big upticks. So that's something to keep in mind, is that inflation comes down, mortgage rates come down. We might be in a recession, and hopefully it's not a big one, but housing tends to stay strong throughout the recession. And why are we confident, that maybe for current homeowners, that this housing recession, correction, whatever you want to call it, won't be as bad as, 2005 through 2009. And basically, you could see there was an uptick already in bankruptcies in 2003 to 2006. And then really the foreclosures started and so forth. Whereas, the last few years, things are at such low levels. It already leveled off. The bankruptcies didn't hit these huge levels like they did prior to 2000, the previous housing crash. So basically, consumers are in a much better position. And then this actually came out today. This is CoreLogic's loan performance for the month of January, I believe. And so as you can see, January, we're actually better across the board this year compared to last year, actually. A couple of them, they ticked up slightly, but most of them are still at all-time lows. 0.3%, foreclosure rate, which is really, really low, and it was much higher back then. So again, completely different situation we are in compared to the previous housing crash. And another reason, loan-to-value ratio. Loan-to-value ratio, you can see kind of peaked back then, at that point. It's been getting better since then. And then equity. Equity is this orange, yellowish line. Right now, homeowners, the amount they owe on their loan compared to what their house is worth is at, sustainable levels, good levels, and equity is at all-time highs. So again, homeowners are in better space to handle any sort of downturn. And part of that is because we, as an industry in the mortgage industry, have done a much better job not giving loans to people that couldn't afford them. As you can see, I've shown you guys this before, not giving loans to people under 620 quite often at all. My company, we don't do that. So basically people are, again, people that have these homes now are in a much better position to handle a downturn than they were back then. And then again, I showed you guys this previously. This little tip right here at the top is all we've lost from the pandemic housing gains. This is still people that bought prior to pandemic. You still have all this equity gain. So house prices have been coming down a little bit, but still the vast majority of us that bought prior to this are still doing really well for ourselves. So that's something to keep in mind. And then, I thought this was interesting. I'll end with this one. Who should we be concerned about? And this is from a appraisal blog in Sacramento, so obviously just that area. But I thought it was a good little example of probably who we need to be concerned about. The only conventional we see in this list is, for the most part, we see some investors. We see a couple reverse mortgages, which are probably people passing away, and that's the way this is shown for short sale. And then we see a lot of FHA and VA. So it's people like that maybe bought the peak and do not have a lot of equity already built up in the house. They're the ones we have to worry about. They're the ones we want to make sure things don't they don't get flipped on their side. So those are the people you gotta be concerned about. So that's all I had for you guys today. Went a little longer than usual. I apologize. I want to give you guys as much information as possible, and I thought today was a good day to kind of do this refresher on this recession thing, because like I said, most smart people think we're already there or we're heading that way. So if you have any questions about this or anything at all, got questions about a program, whatever it may be, reach out to myself, and I'd be more than happy to help you guys. So I'll talk to you guys soon. Have a great day.